Well, good morning, everyone. Thank you for all joining me this Saturday morning. Also, thanks to all of you for the great questions. Um, so first of all, I'd like to do a little quick market review, kind of things I'm looking at. And I know many of you have questions. It was an interesting week. A lot of people were really worried about the CPI report. It doesn't appear that it's had much impact, but sometimes those things are delayed. So let's look at some of the basics here. So this is the chart. We're on the stock charts. So the Spider Trust, Keltner Channels, monthly pivots. I know I've got lots of feedback from a lot of you this year about how effective and useful you're finding the pivots to be. I got a lot of feedback did an hour-long thing after my Well 365. It's up here on the Viper Report YouTube page, right in here, 6,000 views or so. If you don't subscribe to the Viper Report YouTube, I suggest you do. You'll get the first notification once I post it up there, even before the office sends out, an alert. You'll be first in line. So it doesn't cost anything, obviously. So there's lots of stuff there, and hopefully you'll learn from it. So I hope you'll join us. So this is a chart as of May 28th. Okay, and the reason I picked this one up is because you can see at this point in the arrow. So we have the SPY, you have the S&P 500 AD line and the NYSE stocks only AD line. Quick refresher course on that. I follow two different NYSE AD lines: the NYSE All and the NYSE stocks only. So the All NYSE has ADRs, bond funds, all sorts of different things that are not quite stocks, and so that covers all of them. The stocks only just covers the stocks. So people who don't like the NYSE All AD line, that's why they don't like it, because it has the other stuff in it. I've been using it since the 80s, and I've found it generally, oftentimes, in some since 2000, when the stocks only was available, it's actually more reliable. So in any case, at the end of May here, you can see both AD lines had made new highs, and for a change, the stocks only had gotten better. It was holding back here a little bit. You can see during April, it was right in here. It had not made a new high. The S&P AD line had made a new high. So this is a pretty strong outlook going into the month, and if we look, to what it looks like as of Friday's close, here's what it looks like updated, with well, actually it's supposed to be updated, but let's be sure it's updated. Okay, so you can see, AD lines turned up at the end of the week, and they are, still looking very strong. Anytime you get a correction, we saw a correction back in here of a couple of days, you could get a correction, a minor pullback, but it would probably take a number of days of heavy selling to really start to weaken this outlook. And so, that's all pretty much is in sync for prices to continue to move higher. So let's look at what else we got here to look at on our list. So, I got some questions about flag formations on the advanced decline line. So I added these into the current chart. And someone asked me if I see flag formations in those. Yes, lots of times. So we can go back in March. You can see that the NYSE All had a clear downtrend. Those who've taken my AD line course, that's how I kind of time things. I develop. So I like it when I see a 3-point downtrend here. So I'm looking for when it turns around, as it did at the end of March. That's a pretty strong sign. So that's we came back right into support here at that point, and we had another flag formation form in May. We popped out above it, pulled back, and off to the races. Not as clear a one in the S&P 500, but it was also a consolidation or continuation pattern. If you look at where the highlight came from, then you can see that this was sort of like right in here. became, there were lots of opportunities between when that broke out and before the market actually broke out. And, strictly, it's really been a kind of a stock or ETF picking. You can see by the chart of the SPY, it's not been a screaming move upward, but there's lots of things that have been moving both directions during that period of time. So if you look at, into the QQQs, they also look quite good. So this is, the Qs. This is the NASDAQ 100 advanced decline line as of last week. So, I mean, it's, you can see it's, speaking of flag formations, it's sort of got to figure out a nice color that will show up here. But, you can look at, this sort of breakout right in here, and, nice, positive trend. It was sort of clipped here a little bit in May, but otherwise it's up to the races. And so, oftentimes, it leads prices higher, and some of you may have been following me in the spring of October of 2019, rather. I think it was in February. The AD line made a new high, and the Qs were like, almost 10%, 8% maybe below that high, but they were suggesting that, the Qs would also make a new high, and, as it turned out, they did. So it is a pretty good leading indicator. It's looking very strong here, suggesting that I may have been a little too cautious on growth in the past couple of weeks, but we'll get into that in a second. So other things that I look at, on an ongoing basis, most of you who, subscribe to my services have seen these pretty often. So, this is the NYSE advanced decline differential, and it tells you, what the short-term overbought, oversold status is. So you can see this purple line here. That's a 5-day moving average of advances minus declines on any day. All right. So, it often turns ahead of prices. So you can see right in here, we went up for like another week here, a few more days, etc. So, it doesn't pinpoint the lows or the highs. It's a little bit better on the lows. It often happens like within a day or two, but it tells you whether, if it's screaming up in here, it's probably not the best time to put on a long option or a bullish option position at that point. So, it's, just one thing that I look at, and, I look at it for a number of different market averages. So, there's some other measures we look at here. This is a weekly chart of the cash S&P, with the equivalents of the Stark bands. If those of you who are stock chart subscribers, please email them to ask them to add Stark bands, or at least allow you to change the moving average in Keltner Channels. I know a bunch of the principles, and I have no effects, so maybe you customers will. So this is an interesting thing. I talk about in the newsletter periodically, and sometimes in Forbes. It's the NAAIM equity exposure. It has given some pretty interesting signals. In 2020, it was diverging. So this is an equity exposure, before the market cracked, got way down here into under 20. And, at the lows, nice little uptrend. We broke briefly here, and then it's formed lower highs. So, it's a sign that maybe, it's a realization, if you will, really, rather that the, some of the investment management firms are pretty nervous up in here. That's pretty obvious with what the press we've been reading lately, and some of the sentiment numbers. Below that, we have the AAII bullish, and you can follow that. It comes out every Thursday. It peaked up here about 57, I think, in early April. It's been declining. High levels in this don't really tell me a lot. It's more the low levels. You get some pretty nice bottoming formations in this indicator. So it's not like 10, 15 years ago, if you used to get above 60, it was pretty much a sign that things were pretty well stretched. Now it's not so clear. A lot of new players. One of the risk parameters I follow. So this is, once again, we have the S&P, and this is the stocks above the 20-day. Okay, so right as of Friday's close, 63.8. You can see it's been as high as 90 plus. These lines are at 85, I think, and 40. And so when it gets down to 40, and particularly when it gets down into the 20 range, that's usually, if you were to look at, line up some, some vertical lines here, you'd see that, that was the, well, if you do it in a color that'll show up, it really will help. But, you can see that was, in the start of November, late October. This was in the September low. So it's a risk sort of thing. Right now, the risk is moderately high. None of the, so right here we have the number of stocks above the 50-day. It's never gotten. Last time it got down to 40 was in that decline we had at the start of February, end of January. 200-day. Yeah, I mean it was under 10, at the March 2020 lows, but never has really bulged. So these are something I follow on a regular basis. I also follow the 10-day on the NASDAQ 100, which is quite reliable. So on the daily review, last thing I want to look at is the growth versus value. So I still think probably a major top was completed last fall, but you can see growth is improving. So when this is falling, all right, value is outperforming growth. When it's rising, growth is outperforming value. So we had nice little potential bottom formation here back in early May. And the rally has progressed a little further. The MACDs, et cetera, are suggesting that that ratio could get back up into this range. You always, the nice thing about technical analysis, over fundamental analysis is that you always have, you can, if you do your work, you can figure out when you're going to be wrong. Okay, so with this ratio, if you were to get a close above these highs up here, it would say that the value is still in the long-term downtrend. Won't cover it right now, but for those of you who are not familiar, so essentially value bottomed out in 2000, 2001, and was in a bull market until 2007. And during that period, growth was really underperforming. They're both going up, mind you, but just at a different rate. And of course, we know what's happened, since 2009, because growth has just steamrolled ahead of it. Last year, unfortunately, one well-known value manager, right as it looks like that ratio may have peaked out, he shut down his fund because it's been so tough. So I think value still may have its time there. So, but you can look at Forbes if you want more that I've written on that. In today's thing, I kind of want to focus on a couple of more on the sort of continuation patterns and hopefully, address your questions as they come along. So one of the things I try to do is I try to find a strong stock that's had either a pause or a correction. So this is ABBV. And he had a really nice rally up into June of 2020. Came back down. Many people are amazed how valuable the yearly pivots can be. Most platforms you have to really stretch their numbers to get them to show them, but stock charts, for some reason, you put a weekly chart in, they give you yearly pivots. So you can see this is the pivot level right here for in last year. The S1, S2 was way down here, R1, R2. So, we came down, moved back above the R1, came down right towards the end of the year. You can see the 77.26 was just almost right on the yearly pivot. Since then, we've been holding above it. And, but it gives you some, examples of, this formation. If you're thinking, okay, well, if we're going to break out this to upside, the 120, 127 was not an unreasonable target. 137, a little more ambitious. Okay. So, then you look at what, how that formation is. So if you look on the daily chart, these are sort of on my watch list sort of stocks at that point. I talked about this in the April Wealth 365 presentation. Make that a little darker, this sort of this trading range. And, you can, and we talked about the fact that, well, okay, if it does break out above this 1174 here, just above 100 there. So it's 11-point range. you tack the 11, onto that 110, you come up with 121. Yeah. So if you're looking to an option trade down in the 104 area, it says, well, okay, I can go 115, or I can go, 120. Gives you a couple different, depending on your risk reward. The OBV at this point in time, this was a chart that's as of April 9th. OBV was still, below its moving average and locked in a trading range in a downtrend. So nothing really happening, at that stage. So if we'll switch forward a little bit and see what transpired. So that was as of the 8th. So now we'll go towards the 23rd of April. Okay. Now much different picture. So we've broken out of that range, and by a slight amount. I think we'd hit the monthly R1 here. So you could get a pullback. OBV is starting to look quite bullish. All right. So no problems there. One of the questions somebody submitted was, well, if you're in a trade and it breaks out, how do you determine if it was a false breakout? We'll have a couple of examples of those, but it was a definitely good question. And it's not unfortunately, there's no shake and bake 1, 2, 3 rules to do that, but I'll try to answer that question. So let's go back another week. So we moved another week. So now, the market seems to be consolidating right around that R1 level. So, if you're in that option position, you're from here to 04, it's been moving sideways for a number of days. I always, if you're in this case, at the end of April, when you're a May option, then you might think about taking some off because you only have 3 weeks later. So it could, you break out of this formation that took roughly 1, 2, 3, 3.5 months to develop. You could move sideways for a couple of weeks and not really change the bullish buzz as long as the OBV doesn't turn. And you can see the OBV has gotten even stronger in that week time. So let's fast forward again, towards see what happened in the next month. So, we paused. Okay. So now this is as of May 21st. We just paused here and then we accelerated the upside. Now we're up towards that 116, 117 area. Up in here. We cleared the new R1. Remember, this was the R1 for in April. Now we have the R1 for May. We cleared that. And as you can see, the 1870, was the R2, and we're bumping up into that. So certainly, I don't like to see, a market that has this number of days. If you look at, you can always with stock charts, you can inspect it and kind of see what the volume was. But we, went from May 5th, essentially the entire month, we're just up there. So if your option is in the money, it's not treating you well, and so it's sort of a matter of, from here, no real signs of a top, but where the risk is, and where the support is now, in the 1170 range. Oftentimes, I will take this chart and, I will look at it on an hourly basis to find some levels of support. Questions up to this point? I trust everyone that is following the charts okay. Not, you can unmute yourself if you have any comments, but I think it's so what do you do in this situation? All right. So let's look at what happened to the current environment. So that was the 21st. So if we fast forward to June, we go say June 3rd. We've gotten a correction. Different sort of correction. Now we're into, we're coming into the new month, and let's show a little less data so we can, see a little more of what's happening. So we'll go March of 2021. You can see we've had a, detailed here correction. So we're right into the S1 here, and, OBV, no real strong divergences, in the OBV, but it's below its moving average. And but once again, the weekly is still looking strong. And so, it looks like it's probably another buying opportunity. And of course, this week we've had a really sharp move to the upside. Right now, I'd like to, this OBV pattern is not, impressing me too much. So if you weren't in this market, I would not be in it. I'd be looking for a pullback here at this point to see how the market behaves. But you can see we did get right down into that S1 level, and it was it looks like it was well supported in there with the way the volume kicked in. So it's the whole process is interesting to, and you can, if you're testing out some method you're using, whether you my stuff or somebody else's, you can. It's really nice to have this feature in stock charts. You can go forward and back in history. This was another chart, I discussed in April, and you can see it just come out of its flag formation. Why do I like flag formations? It's usually, it's a thing of, the sentiment, during this period. So this was Dow Chemical last fall. People were into the chemical stocks in early June. You went through this like 2-month period here, and they're out of favor basically. And so you're just breaking out of this wedge. Your OBV, is still looking pretty strong. Relative performance, remember, it doesn't tell you the direction; it just tells you how it's doing. Versus the SPY, it was doing pretty good. So from this point, you were saying, okay, well, 43.74 was the high, 35.89. So we'll round that up and say that's an 8-point range. Maximum down here was probably about 9 points, minimum 42 to say 37 or so, so 5. So then you add that in to say 42. So you can say, well, I have a target of 47, or I have a target of around 50. So if you're trying to determine whether your risk and reward is appropriate, or if you're an option trader, figure out what option you want to trade, then that gives you an idea. Say, okay, well, maybe at that point in time, you were looking at the if you're conservative, the 45, 48. If you wanted to get the cheapest option out there and hope for the best, 50 strike price option probably would have been a good idea right in here. You've just had a little pullback. And, so that would have been the various things. And, you want to measure, obviously, further out of the money, higher reward, higher risk. There's a much greater chance that position is not going to, work out for you. Overall market, was a little frothy in August. And so you have to take in the market conditions. So, what you're writing in the end of August, though, when really didn't know at that point that SoftBank was buying all these naked call positions that were forcing the option makers into hedging their positions in a way they weren't, frankly, I don't think, used to. So that adds some pressure. So if you looked at, if we go back to let's see where. If we look back at here, you can see in the the risk parameters back in, right in here in August and September, they were all near, much higher than they are even now. Okay. We had to sort of blow off top. So you have to take that into consideration. If you're looking at that stock, you would have waited, until September possibly would have been a better choice. So, let's go a little further, see how it held up during the September decline. Was over about the 18th. Perfect. It didn't correct at all. You can see it just soared to the upside. So you made your first target, and you made a second target at 48, and it was a pretty good move. And you could, so the option strategy would have worked. You can see the OBV was still really strong there during that period of time, completing that flag formation. So, the tip off, if you were watching the tape, I have CNN or CNBC on or Bloomberg on frequently, but I generally do not have the volume on. It's frankly becomes a little irritating. But if you looked at the tape when the market was really getting hit right in here, you can see Dow. I mean, it did not drop at all. during this period. So there's like a 2-week decline. Look at how the relative performance is acting in here. It was really acting very strong. So that's what you want to do when the market's correcting, and if you're not really bearish, then you want to look at the tape and say, gee, what's bucking the trend? What stocks are not, declining as the market is declining. Those are the ones I want to maybe concentrate on. So how do you find stocks? There are various methods you can use. One method I look often to is FinViz. I've switched to a FinViz scan, so hopefully you can all see it. This was set up for stocks like CRM, I believe, and Team. So it's a nice way to get, if you see something happening. So let's say we can look back and say, if we go, I don't know if this data goes, oh yeah, it'll go back enough. So let's go for Dow, for example. So one we were just talking about. So it's a chemical company, okay? So, and you probably want to, raise the market cap to, at least the mid. Maybe it's just small because you cut down too many of them, and then you. Ooh. Okay, well, let's go back. Let's go back to all. And you get a set of charts. You hit charts here, and you can see, well, let's look how they were doing, back here. And so here's our sort of our benchmark, and down in here, doesn't really, this is the one that was breaking out. We hit 50 in September. So you're looking for those stocks. What the rest of the group did here, you can see, it was a good way. Lots of more coming out of bottoming formations here, back there, and then of course you can flip on it, and you can see that if you look at the weekly chart, you can kill the goblins. I don't think so. And you can see the kind of decline it had right in here. This is a little, another little pause, consolidation here we were just talking about. So that's one thing I look for. Also, they have a setup on their homepage. If you can go to like, wedge formation. So, Sterling Construction. So, it just came out of a continuation pattern here. Stock doesn't trade, as I recall. A whole lot of volume. Let's see, what is it? To average volume, target price, 255,000 shares. Not horrible. Probably, options are not very tradable in here, but same sort of thing. So then you look at the weekly chart. You have a crazy trading range. This would make me a little nervous. Other than the tails down here were pretty positive. So, there's some pretty good support down here on under 20. But if you look at the upside, 24. So, a 5-point range, 6-point range says that, this could move to 30. The weekly charts often give you some really good perspective on where a market is going, and whether a pullback is a pullback or something, more important. Also, if you're an option trader, you should start to try to monitor the intraday action or the daily action of the options. I think TOS has the best, program for that. So that was one of the questions I had. Lots of stuff to play in here. I mean, so anytime, you see a stock that you think is, like if you go to, let's say if you go to the homepage of stock charts, and you can say, okay, well, let me see, in the S&P, the most percentage up stocks, okay? You look at the candle glance, and, it's a real sort of a fertile area for you. PVH looks like it has a little flag formation here. Some other ones have bounced, but nothing really else that you kind of, is this a bottom, or is this just a pause in the downtrend? Not a lot out of here, except other than the NASDAQ, which is is going gangbusters, as you can see, and it's got powerful OBV, that with the R2 up here, so it's nothing there. But if you aren't familiar with a company like PVH, you may not be familiar with, then you go back to FinViz and say, okay, well, who else, what are the other stocks in that group? Okay, so it's an apparel manufacturing company. So you click on that, and you got all these, and I would, say volume of maybe over 300,000. You're going to cut down those quite a bit, and then once again, you can see a lot of charts. So, to look through. So this is Goose, I guess, well known, nice, sort of flag formation here. It's getting right back into those previous highs. So, that's something that, or if you do like I do, I run a scan every week and, come up with a list of stocks. And then I go through each one of those to determine, which, if any of those, are attractive. One of the questions I got dealt with, taking profits or when the breakout is false or not. So let's look at a couple of those examples. And I think I have, okay, this must be, let's look at the whole list here because I want to look at American Airlines was a recommendation, a position we had recently. And it's a pretty good example. So let's see if I, okay, so. All right, so American Airlines. Okay, so this is what I was looking at. I think it was recommended like on the 17th of May. So let's look at let's add some annotations to it. So you had a pretty nice, sort of flag formation here that was completed. That was the 17th, this big bar up here. So I was trying to buy a pullback. I think we got it around 2240 or something. So it started acting pretty well. So, you can see that the OBV, shows a positive trend. It's also, broken its downtrend, relative performance also looks positive. So when you're that kind of setup, I'm less worried about a breakout failure, but still, given this sort of chart formation, you wouldn't want to see it. The first warning sign would be probably a drop below the 3-day lows right around in here, or this low at 22, 29. That would have been sort of a deal breaker. That's about where we got long, and so that would be a sign that this was a false breakout. They do happen, and let's look what happened. For this one, we can go through to. Well, let's go through till the early part of next week. So we get to the R1 here. All right. So it's had a pretty nice move up. Once again, the sort of measuring techniques, if you were looking at this right around here, you would have said, okay, 26 to 19. So 7 points on the upside. So 29 would have been a reasonable target. So then if we go, forward into June, and we hit June 11th. Okay, so we hit 26, big day up. That was a Wednesday, as I recall, and just reversed. And then there was travel news that came out, I believe, or something. And so I took half the position off right around in here for about a 13% gain. Then it becomes the crux to my strategy or my basic premise. If there aren't any really strong negative signals, and there weren't at this point, both the RS and the OBV were above their moving averages, a bit overextended. So the tough part becomes the stop. So, you move a stop, say under this low, under 24.13, it would have lasted, until June 8th, 23.86. Other than that, you go down here to 23.11. That's pretty far out of the way too. So there was not a really good place for a stop. And turned out we were, I think, stopped out at 23.57 or something for a 6% gain on the second position, 13% overall. Frankly, I think that this market is probably close to bottoming out again. It's coming down into the pivot here. So, the OBV has not looked too bad. So I'm watching this one. And if you look at, we just take a an hourly look at it, let's look at what that looks like. You can kind of, you can gauge out the, using the horizontal analysis we've talked about in the past, sort of like 2311, down to, that 2235 to 2390. So that's your support zone, maybe a little tighter, is right around in there. And so if that is going to resume it, then, your targets, we should, most conservative, be back to that 26 level. And from the prior flag formation, I don't think that the 29 to 30 area, is out of the question. So, that's, one I'm watching. Sometimes, if you, I hope that answered the question. You give it some time, and, I'm a firm proponent of people who scale in and out of their positions. So, if you have the capital to do it, you instead, you put on an option position. If you put on 1 or 2, it's tough. You put on 4 to 6, makes it a little easier. You sell out a third of them at a certain level, and based on the stock, generally, and then you just keep scaling out of it. And most people, the biggest problem is they hang on too long. And certainly, if you have an option position that doesn't have a lot of time left, then you have to be really, you can't really mess around with it. You got to say, okay, I'm wrong, and I got to get out of it, because you want to try to not lose the entire position. So let's see some of the other questions I had. How long of a pattern breakout? So, there's not, I've never found it. So thing took, roughly, we had a low here of March, April into May. So 2.5 months. I would expect out of a 2.5 months to have at least a month on the upside. In terms of, which is pretty much kind of what we got. It's just shorter than that. I mean, that's, you can see we got, we exceeded the Keltner channel, upper channel, and that R1, and, it was a good move. Sometimes, obviously, the longer the formation, the longer the pattern, the more dramatic the move is going to be. So, I mean, if you look at something like, let's see, what do we have here? Okay, so yeah, so here's a couple of ones I was looking at. Sometimes it's easiest to look at a chart that's real basic, doesn't have a lot of indicators on it. So, I mean, this is pretty much a bar chart, not even candles, monthly pivots. And you can sort of, you can see the downtrend parts of the flag formation, and then the support level, here, to a certain extent. So we can see we broke down, we've got a little pop above here in the initial, that really short term, this red line, but then you redraw it. So, I mean, is some art and science, but now you're sort of targeting here that, okay, now, if we get back in towards that, retest the breakout level or the pivot down there, that would be an area of interest. Pretty strong action there. So, that may not happen. If you look at, what, this is a small cap growth fund, so if you go, what's the weekly looking? Okay. So the weekly looks pretty good. You've come out of that range in a weekly. You can see that the yearly R1 is at 75.02, but all this looks positive. So this is kind of what you really big surge in volume here. So, that increases its value as a candidate. Let's see, FR2. Okay. So what did the technical studies did? They didn't really break out at all on that spot, where the trend was, the OBV did, relative performance didn't. So now, when you got back into here, the difference between the April rally and the late May rally is that it started to outperform the overall market, which is a good sign. So this is as of Friday's close. All looks pretty good. Not, in terms of your risk, there's probably a close underneath the pivot, which is at 69.52. So, you're at 72, 97, it looks like. So it's a bit above it. And where, I hope, if you aren't using measurement techniques in these charts, and you may have to prove it to yourself, because I've been teaching technical analysis for a number of years, and most people sort of, sometimes look at chart measuring techniques as somewhere between voodoo and scratch off lotto ticket. But they really do work, and the only way you're going to convince yourself is you do it yourself. But you can see, you got this, and then I tend to measure it. Well, let's take this line back a little bit here more. Take this one a little back, sort of traditional. Edwards and McGee is like still the Bible of chart formations. And then if you look at, the width of the formation here, say the width of the formation here, and the most conservative be the width of the formation there, and it gives you some targets. So, for example, 65 to 72 gives you 79. Okay. 84 looks like down to 65. So that's 19, if my math's correct. So you tack 19 onto here. That gives you more like a $90 target. And so, those targets, and once you hit the minimum target, then you start looking at the other ones. But it is something I think, you take advantage. If you have trouble seeing it when you have all this stuff in there, one real easy way to do it is just, instead of looking at a candle chart, change it from candlesticks to a solid line thick, and you'll get a much different formation. And you'll see the flag or the continuation pattern pretty clearly when you do that, but it'll give you a quite a bit different perspective. Let's see, do we have anything more from okay, so ICE was another one we looked at. Okay, so similar sort of take the flag formation here, and you can draw your lower support line from a number of, it could be from here, it could be from here. One thing I really like about stock charts is that, if I were, for example, if I were going to be buying it right around in here at 111, I wouldn't use a stop under here. I would tend to go back to this low or even that low. I mean, so this, this is, my eyes are not deceiving me. This is 109.70. This is 108.79. So it's a buck difference. That it's going to be, give you much more staying power, because you do see, wild gyrations. I mean, look at this day right in here. If you look at that had a humongous range, and if you had a tight stop, you're out of there. So, this one, the OBV, started to turn around in April, and, let's save that. So, well, that was the formation. You sort of had an idea. Once again, 116 to 109, so 7 points up maybe, and a higher target was 10 points up. So you tack that on to right at 115 and a half. So 122 to 125. So how to work out, so, you immediately got there, I mean, frankly, I didn't remember what happened to this one, but so you must have probably had to go a week further. We got up above the R2. That I think if we add in, if you want to add in Keltner channels, which are this, as I said before, the closest you can get to Stark bands and that. So the defaults are 20. That's the moving average. So you want to change that to 6. And got to put a comma in there. And then you want 2 times the average true range. So remember, the Stark bands take a 6-period moving average. They add 2 ATRs to the moving average to get the upper band, subtract 2 ATRs from the lower band, and you calculate the ATR over 15 periods. So, you put those bands in there, you got pretty close. So, then you had that correction. So let's see what ICE is doing at this point. Let's see, that was as of Oh, 8 May. So, right back into the triangle formation. Well, then we should go current. Interesting. So, now your resistance, volume in the end of last week was pretty good. You can see we're right back down into that, 109.60, 109.04, still above that support from back in there. So let's, of course, you see something that looks that interesting, then you're going to say, well, okay, let's look back and see what the weekly looks like, give it a little more room. Weekly. So, we use support and resistance. So the weekly OBV is broken its support and is negative currently. So that's a little concerning. And so if you look at the OBV support, for example, here, up to here, I guess it hadn't broken that. So that's the kind of level I'll be looking at. So below its moving average, might bear watching, might be on the watch list. Those of you who have, TOS, you can do some really interesting things for the for option pricing. So let's look at this other screen here. We'll see. So this was the American Airlines call option. So this was the June 20, I believe, June 20. Yes, June 20 option. You can see it had a pretty good move. So this is, sort of when it started, turning positive down here. We went from, a couple of bucks, up to 7. So this is sort of, you get your first move up, and a second one, and for this is a daily chart, and had a pretty deep correction. So this is where we completed the flag formation just recently. So we went from 2 back up to a 6, and now we're back into the, I guess, what is that, 355 range. So you can look at the support levels do work pretty well. I'm assuming that most of you do not use, market orders and options. If, unless you're trading the SPY or the Qs, you're probably, you probably be okay there. But otherwise, you really want to go limit orders. And I use and teach using, like intraday charts to help you determine the entry point. So like, for example, if you want to get in, and so that was on the, let's see what date was that, was the 18th of May. I think we were extended that to, so the buy signal came. We were looking for a pullback, so that option went from a high of 415. 2 days later, it was down to 377. So 415. So it lost 10%, I guess, at that point. But you don't want to chase it, and clearly, these bands will highlight. So if you start to see, like this bar up that had a high of $6, well, the next day, it opened at 525. So if you think something is way too bullish or way too bearish, then I do often take positions and say, okay, well, I'm looking for a move 30% below where it closed yesterday, and I'll put a limit order in at that price. Sometimes it works out great. Sometimes the market keeps going lower, so I have to bear that heat. But it does. It is a way to take the. So let's see. So I have a question. Tom, do you like measuring better than fib levels? No, not better. I like. Thanks for the question. I like a combination. So if I can get, a dream situation to be measuring targets, fib levels, and pivot levels, you get all three of them. Sort of. I think I mentioned before, and I maybe the title of this upcoming Wealth 365 is sort of the wealth of the evidence. So the more data you can align that supports your position, the better. And that's way I like it. So if you can come up with some sort of, method. So let's, if we look at, should be back to stock charts, I think, from here. But, it's just sort of like the same thing. If you're, you know, if you're getting nervous about, say the QQQ, or let's say they use an SPY, then, you should be, you look at the inverse, say the SDS or something, if you're thinking, okay, well, the market's really vulnerable, and you look at something like the SDS, it's a weekly chart that's not going to tell us hardly anything because it's been getting creamed so much. But, you look at the opposite side of the position. Well, there's nothing really bullish in this daily chart of SDS. Okay. So, or if you look at the VIX, it's also not really, showing a major bottom, or a new uptrend. So, based on that, it sort of says, okay, well, maybe I shouldn't turn as cautious. So when I target, an entry level or an exit level for that matter, I tend to use a combination of stark bands and pivots, fib levels when I can. But, then it comes into, stuff that, it's more like the Fibonacci extension sort of stuff that we talked a little bit about last time at Wall 365. Stock charts really doesn't have that, that handled very well. So it's sort of, it's a different, and not all platforms do. Not all platforms are, are created equal. I mean, I think if you go back to that that option, so if you can, you can take what's called an equality target. Let's see if I can manage this without messing it up too much. Okay, so, sometimes it's not too friendly. So let's say if you take from here to here, that rally, and then you project it up from that low, you get 100% target right up in here, 538. And, conversely, if you take it from here, down to here, okay, that's the first leg of the correction. And where's the second correction? The 100% level turned out. I mean, I haven't looked at this particular option using this method, so I'm not really cherry picking. I'm surprised as you are that it turned out that well. But anyway, that's the sort of, technique you can use. And it's based on the fact that, one move and will be followed by another move of a similar magnitude. You can do it in stock charts pretty easily. You look at and if that level, correlates with a pivot level or a stark band, that's really ideal. Other questions? Thank you for that one. Guess not. Well, I appreciate all of your questions you have had. It's some of you. Do you look? Oh, one I didn't ask her was this: if you see a pattern breakout on a daily chart and then price begins to consolidate, do you look to prior moves in the same stock to determine likely behavior? Not really the magnitude of the price moves, but I do pay a lot of attention, obviously, to the price levels. Okay, and and also same sort of thing, to the likely duration of a move to determine a time frame for options. Just everyone, give yourself more time, than you think you're going to need. My personally, as well as many people I've talked to, have all had the experience right on the market, right on the direction, cut themselves 2 days, a week short in their options. So they were on the sidelines and it did exactly what they thought it was going to do. And, that's often happens. And, so that'd be the main thing. And don't be greedy. I mean, it's sort of like, if you get a quick 60% move, most of us think, well, oh man, this is going to be a double, and it gets to a double and you think, oh, it's going to be a triple, and that's about the time it probably craps out at about 140 or something. And, you're not in anymore. So, other videos, there's a number of them here, different topics. I mean, there's some of them are just updates. So like this one from last Monday, I guess, was an update, sort of in reaction to, everyone was looking, for a 10% correction. I think a 10% correction is likely this year. Just don't see, it coming right away. So, yeah. So, I mean, I would be surprised if we don't see that sometime between now and the end of the year, given what the market's doing. I dig a new question. So, going back to the advanced decline line, do you think that using daily AD line gives you more whipsaws compared to weekly? Definitely. Basically, I mean, you got to look at the really. Oh, I know one question I did not answer. Yeah, my bad. Here, let me see if I can find this. I think the weekly and the monthly. I mean, if you look at a chart of, I think I have it set up in this platform on this PC. But if you have a situation where you're looking at a monthly is the biggest one. So then it's been above its moving average, since the March of 2016. Okay. And so, it's really the long term. I tend to, and unless I see some really weekly divergences, that's where I get more nervous. And frankly, we haven't had any weekly divergences since 2016. Okay. So that, I think that's the daily is really more for trading. And then if you get, those sort of top formations that you often see, then it's going to say, okay, well, this is a correction that, I should, avoid. So let's get back to the right screen. Appreciate that. Okay, so now you should be able to see a screen of the NASDAQ and, I mean, of the NYSE Composite. No?
Yes.
Okay, good. Okay, sorry about that. So anyway, this is a contribution from a client. So anyway, back up a little bit. So here's this, this rising wedge formation, connecting these highs, this high and longer term, we're reaching the apex up here of a multiple number of narrowing wedge formations. So, the base thing is a wedge is it's characterized by a sharp drop in the opposite direction. The problem I found out, both, in the 90s, used to see them quite a bit in the foreign exchange markets and in individual stocks, is they only really get interesting when you get near the apex. And usually, the moves out of those are not what you'd think you might see. And they're so brief that it's really, it's not like, you're switching from a bull market to a bear market sort of scenario, which is what my experience, a lot of people tend to, equate them with. So like, if you look at this, back in here, we had a great run. This is from, the 2012 low in June. You had a year and a half, 18-month move up here, and we got, there were really clear signs, right at this point here in July that the market was in trouble. Don't have a chart handy that I can quickly flip to, but the AD line and the NASDAQ 100 gave a major divergence right at this point. And of course, we got this plunge, downgrade of U.S. debt, and things pretty much went sideways. I mean, if you search, and you can do that, it can be quite interesting. A client and I were looking at Square, and we saw this rally in Square against a major trend, and I said that's got to be news related. And so sure enough, you can say, you could Google, SQ, whatever was it, March 2nd or something. You saw they had this new partnership, and the stock just shot up, but it was a one-day deal and hit right into monthly resistance and failed. So, if you look in September of 2011, you'll see all these headlines: new recession underway, et cetera, et cetera. Bearish sentiment was really high, bullish sentiment was very low, and you got this rally that is caused for another major push to the upside. So they don't, I don't think they're too reliable. I think maybe I have. Let me see if I have an NYSE AD line chart in this one. No, I guess not. Let's see here. So, and if it is going to be a major top in there, then I would look for it to be, the AD lines to be looking a lot weaker than they do. And no, wrong selection. Those of you can see that, the number of lists I have going here is, here's 2018. So maybe this is, yeah, this is the last thing. Not really on point of that question, but one question I got was about, leading behavior of the advanced decline lines. So here we have the NYSE. Here we have the stocks only, or we have the all AD line in green, stocks only AD line down here in red. And we had this horrible decline from September and October down to the end of 2018. So if you look at, the NYSE all AD line, it formed a negative divergence right here on the 21st, I believe, of September. Yep, September 21st, it formed a lower high and then started to break down. So you can, if you have stock charts, you can recreate this, but you can see it was just by the end of September, it was in a downtrend and below its moving average. So that was the start of quite a wild quarter. Many were convinced that we were in a bear market at that point, but the weekly, there was no weekly divergence. And actually the weekly AD line during that period held up better. So when we got the rally back, right as where this marker line here was February 20th, both of these AD lines made new highs, as did they one on the NASDAQ 100. And they were an indication that the market was also going to make a new high, even though you can see, the NYSE was at 12,680 and the high was up around 13,240. So they gave you that leading, indication at that point that, the market was healthy. So rather than chart formations, if you're looking for a major average, I would not be too worried about a rising wedge, because I think if you're going to, and thank you all for tuning in, and thanks for all your responses.